Hello, everyone. Today I'm joined by Shawn Xu, a partner at Lowercarbon Capital. Hi, Shawn. Where are you dialing in
Hey,
from today?
today I'm in New York City, but usually I'm based in San Francisco or in our office in Los Angeles. So this week has been a little bit of traveling across the country.
Awesome. Yeah, I'm sure you're always traveling around meeting different startups given your role. So glad that you were able to make the time for us. Super excited for this episode. I think it's going to be great.
Yeah, happy to do anything Wharton and Lauder in particular. So, excited to chat.
Before we start kind of diving into the details and getting to the nitty gritty, I would love for you to sort of explain what is Lowercarbon Capital, what is your role there, and maybe how you sort of found yourself into the climate investing space.
Yeah, good question. So Lower Carbon is a multi-billion-dollar venture fund founded by Chris and Crystal Sacca to only back companies that are working on climate change. So the story here, I think, is quite interesting. Chris and Crystal had a great run in venture more than a decade ago. They founded a firm called Lowercase and basically invested in some of the most iconic software companies that are household names today. He put a very, very early check into Twitter and grew that position into, I think, the largest ownership position of the company at exit. He invested in Uber, was on the board of that company. I think a lot of that business model was hammered out on his kitchen table, invested in Stripe, invested in Twilio. I think by multiple, the most successful venture capital fund in history. And as a result, he retired, as one does, when he personally became a billionaire, and ended up in his retirement years after 2015 in his 40s, investing in companies that fulfilled his personal passions. A lot of that was criminal justice reform. A lot of that was democracy activism. A huge part of that was climate activism and climate change. And the climate work as an angel investor investing out of his family office, that catalyzed a lot, I think, of what we see as climate tech 2.0 today. And now we see, fast forward to today, there's like 25% of venture capital dollars last year or maybe the year before going to climate tech companies. 6 years ago, Chris came out of retirement and built Lower Carbon as an institutional fund, building on top of his experience investing in dozens of climate tech portfolio companies. From what have we done in the last 6 years? We have raised basically 8 funds. So a couple $1 billion under management, as I mentioned. We have more than 100 companies in the portfolio now. And the thesis of the fund is pretty straightforward. I'd say we think a lot about how to cut emissions to zero. So that's a lot of energy transition and electrification. We think a lot about industrial decarbonization. So core inputs into industry. How do we make that net zero? And we have a dedicated specialist fund in fusion. So commercializing fusion that saw a scientific breakthrough just last year, frontier investments in energy. We have a second thesis around carbon removal. So permanent carbon removal, sucking carbon out of the sky, storing it away somewhere. That has a dedicated fund as well, led by the guy who got the $1 billion frontier commitment to buy carbon removal credits, spearheaded by Stripe. The guy who was instrumental in that effort is leading that fund with us. And last but not least, we think a lot about adaptation and resilience, thinking about how to mitigate climate disasters. The flood, wildfire, drought that is going to increase in severity and frequency. How do we actually adjust to that reality? So that's like reinventing insurance markets, for instance, or figuring out water stress and sucking water out of the air. A lot to do. Here at Lower Carbon, I'm a partner at the fund, so I spend a lot of my time thinking about software and software-enabled hardware investments, given my background as a software investor and generalist investor, really. And I also spend a lot of my time looking at emerging markets. That's because my background as an operator involved that. So it's a little bit of a perfect Lauder Wharton job. And I now take care of our portfolio of a decent chunk of that 100-company portfolio I look at.
Awesome. Thank you so much for that background. Now, kind of like diving into the portfolio, I think you gave us a great overview of sort of the different areas that Lowercarbon Capital invests in. I think this is pretty common in the climate space or like in the sustainability investing space, but not maybe super common outside of that, is the fact that Lowercarbon invests in sometimes more hardware and asset intensive or capital intensive startups. I'm kind of curious to sort of understand how you guys think about that, because traditional conventional thought says that those businesses are harder to scale, more capital hungry. And A, do you think that they represent the same business opportunity as maybe just a software startup, or B, you invest in them because they're just a necessity for the climate space?
Yeah. I guess let me ask you a question, Julian. Of the top 5 market cap companies that are publicly traded, right? How many of them do you think are hardware companies?
I guess it depends on what you define. Apple, for example, is ultimately a hardware company in some sense. Same thing with Microsoft. Some hardware, but I would say that they're probably more of a
Microsoft's, yeah, that's true. But NVIDIA,
NVIDIA, sure.
Google, Amazon. I think that most valuable companies in the world, Saudi Aramco, some of the most valuable companies in the world are hardware companies. And I also think that many people tend to forget actually that venture capital, like we had this exuberant cycle with software. And I think it's awesome. I came up in the industry investing in software, but the origins of venture as an industry was to back the semiconductor industry, right? Fairchild Semiconductor, it was a hardware company, frontier tech company in 1957. And so I think that the roots of what venture capital was designed to back and the magnitude of outcomes that it was designed to back look more like hardware companies than software companies, where there is a tremendous amount of competition, where the valuations are out of whack. I think if you look at any of the AI companies that are getting funded at seed stage valuations, the multiples would drive you bonkers, right? I tend to think that there is something here where what we're building, what we're investing in are companies that are cheaper, better, faster than some incumbent process. When you look at energy is one of the largest sectors in the world, I think measured in the trillions of dollars of TAM. You have these companies that are going to replace incumbent companies, because when we talk about energy transition and climate, we talk about a new industrial revolution. We're going to talk about replacing the Saudi Aramco in the future, replacing Monsanto in the future, or replacing any of the incumbent industrial companies that already have captive markets and also tackling trillions of dollars of TAM. And those companies, we believe, are such high magnitude outcomes that can fit within the venture returns timeline that it's worth chasing after. And there was a period of time where a lot of these companies, I think, had valuations that were much more down to earth. So they were actually better investments, I think, for early stage venture capital firms. I mean, that's how I think about it, at least. And I think that there are certainly software companies that I'm excited by. I've invested in software on behalf of Lower Carbon. I'm really excited by companies in our portfolio like Solugen, that is able to take an enzymatic process to produce industrial chemicals in a way that is cost parity or cheaper than the petroleum-driven processes to produce that same chemical. Captive double-digit billion-dollar market. Are you able to produce a chemical that is cheaper and better for the planet? Piece of it is just kind of an added benefit on top. But if you can produce it cheaper, you sell into a market that, well, ultimately this company is worth billions of dollars today. I will invest in Solugens all day. I think that's how I'm thinking about it.
Comparing it now to the typical software investments, I've heard sort of like a lot of chatter around some of these hardware investments, especially some of like the bigger ones that I'm thinking of in terms of like carbon sequestration, removal. We talk about fusion. They tend to start looking more like infrastructure or project finance investments. Is that sort of like how you see it from sort of like the VC side? You know, you're now more sort of underwriting this longer 10-year horizon, maybe business, as opposed to something that's going to grow in a year or two and sort of start immediately giving you returns. It's much more sort of closer to a project finance model.
Yeah. Well, first on the software side, I think the era where you would have these venture capital firms back software companies and get exits within 2 to 3 years and you're able to recycle those returns, that doesn't really happen anymore. I think all the software companies or the big tech companies got a little bit wise and they basically are like, okay, well, if your software company is struggling, we'll just wait you out. Instead of acquiring your company, we'll wait until you are desperate for cash or desperate for any sort of outcome. And we might wait until the company fails and then we'll acquire you, quote unquote, right? They're not acquiring anything. They just acquire the talent and then give you a lifeline with a job. The acquisition in 2 to 3 year sub like $100 million outcome world and software, I think has gone away a little bit. As it relates to timelines for hardware, we tend to believe that you are able to have these venture outcomes with real technology risk companies, whether it's energy storage or it's fusion or it's carbon removal. These are companies that have offtake agreements and commitments from customers in the hundreds of millions, if not billions of dollars over multiple years. Do those companies find exits within that 10-year period? I think the answer is yes. Do those companies tap into different capital sources than software companies? I think the answer is also yes. One of the things that we're excited about is that there's a lot of non-dilutive public sector capital that is accelerating a lot of these companies that are crucial to national security. I mean, securing the food supply chain, securing energy. These are all things that are relevant to national security. I think that there are a lot more dollars at play that also help these companies scale without having to take on equity dollars. And will project finance be a crucial part of these businesses? I think the answer is also yes. But I think that the permutation of capital to basically get these companies going and get them to an exit, I think will look different than software for sure.
Yeah. Let's maybe go to this later, but because you brought it up, I'm kind of curious around the public sector's role in sort of like climate investing, right? There's like the IRA, which obviously provided sort of like a lot of capital and subsidies for businesses in the space.
Sure.
And then you mentioned sort of like the non-dilutive grants, and that specifically comes to mind in a lot of energy related aspects. How do you think about that in terms of underwriting your business case? Say there's a change in the administration and sort of that public sector support goes away, or is there work the Lower Carbon team does to maybe help their portfolio companies apply for grants, receive some of this funding, better position themselves? Kind of curious for both of those.
Yeah, it's a great question. So first of all, I would say climate is a global problem and it is not going to go away. And I think that many governments around the world are investing public sector capital into it, not just the United States. Regardless of what happens in the United States, very important economy, 2/3 of our portfolio is in the United States. There are still companies that we will back, and in fact, that I prefer to back, that will survive and thrive, not just survive, thrive, regardless of political affiliation of whatever government is supportive or non-supportive of it. If you go back to the thesis of being cheaper, better, faster, conventional market forces will choose that technology solution and scale that business by itself. I mean, I think renewable energy is a great example of that. I think if you look at solar, the levelized cost of energy for solar is now cheaper than coal, cheaper than natural gas in most parts of the world. It just is the most natural, obvious, economic no-brainer decision to build new energy generation through solar, right? Or solar and storage, let's say. That has less to do with the public subsidies, I mean, depending on the market that you're in, right? And more to do with the cost curve for the hardware and the innovations in this space over the last decade or so. That's one point. Global thing, global investment opportunities. US isn't the only thing. Second, if you just look at the US, I also love this question because when you look at the IRA, most of the dollars are going to conservative states. If you're building these battery facilities or EV manufacturing facilities or anything related to the new industrial economy that is emerging, that is all decarbonized. And again, we're shifting from this petroleum fuel-based economy to a mineral-based economy. All those jobs that are attached to that new industrial economy, a disproportionate share of the economic benefits from the IRA are going to conservative states. To the point that you have like Marjorie Taylor Greene going in front of the press raving about the green jobs that are coming into her district, regardless of whether she calls them green jobs or not. They're green jobs. I think that the economic structure, the incentives that are in play here are such that I think that large parts of the IRA are not as much at risk as people seem to be worried about. And as I think about, even if you think beyond the federal stuff, you just look at individual states. I mean, California is one of the largest economies in the world by itself as a state. Or if you look at individual cities and the policies that they're enacting to kind of subsidize and be buyers of some of these products we're talking about, I think there's plenty of work to do and plenty of companies to be built just on that.
Yeah, that's super interesting. I think we're almost getting to a state, I think climate for a long time, people thought that it had to sort of have this public sector support to kind of get there. But it's interesting to see now that it's like, in many cases, just like the right business decision to do. I mean, it doesn't need that support, which is like super exciting. And I think because oftentimes it felt so far away that people were talking about carbon markets and taxing carbon while those were sort of implemented, it always felt like a really far away dream to get there. So it's exciting to sort of see that it's like here just as it is without sort of needing to stand on something else to give it the support.
Totally.
One thing I now kind of want to change gears into is the software space. I mean, like traditionally came from the software world. That's sort of like the bread and butter of VC, at least when I grew up, and it sounds like when you did too. And I'm curious to sort of like understand the role of software startups in the climate space, because I think for everyone it's a little bit obvious of the role that hardware plays in terms of just building battery storage solutions, solar solutions, the enzyme chemical development that you spoke about earlier. But obviously a lot of these things need to be funded, need to be able to get to consumers in the right way. So particularly, I maybe want to first talk about, it's like, how do you see software playing into this space? And then maybe we can use the example of Eli in particular to sort of like talk about one investment that you made.
Yeah. I think what is software actually really good for? I think there's two buckets that are worth talking about. I mean, aggregating data at scale and making decisions based on that data, I think is where there's a lot of exciting application. An example of that is there are a lot of AI companies out there, but we are seeing a lot of battery software companies that optimize charge and discharge cycles. If you own a energy storage asset that's attached to a solar farm, let's say, you need to know when are you going to charge that battery and when are you going to discharge it? When are you going to be able to sell it into the market? And the energy markets are dynamic. At what point do you sell it? When do you not sell it? We just invested in a company in France called Storio that does a version of this, right? They have a turnkey energy storage product that they tie up to renewable energy assets like wind farms and solar farms. And then their AI product automatically just co-pilots the trading decisions. And the early indications are this will be ubiquitous across any energy asset. You would be dumb to hire a human analyst to manually determine some of these trading decisions. You should just have software do it. If you're talking about these products that can juice up your revenue by 30% plus on an annual basis, and you would be fired if you didn't buy this product, that's one area where software really shines. I think also something that's really exciting is probably aggregating stakeholders and participants at scale again that would not have to transact in ways that they wouldn't have by themselves because they couldn't have discovered those other stakeholders on the other side. I'm really talking about like marketplaces, for instance. Another example of that would be Crux, is another company that I've worked with. Crux is basically, the backstory here is that the IRA has made tax credits transferable, which means you can buy and sell tax credits for solar farms, let's say, right? Let's say you put money into building a solar farm. A good chunk of that you can get back as a tax credit. In the past, you needed to find a stakeholder to do a tax equity deal to be able to absorb that large of a tax credit. They'd have to have a large enough tax bill to be able to absorb that large of a tax credit. Now you can slice and dice that 100 ways and you can sell it to another buyer, right? You can slice it into 100 pieces of 10 pieces, whatever you want to call it. And different stakeholders can buy different pieces. Well, that's a classic place for a marketplace to evolve. And Crux has done exactly that. They have done billions in volume where they're connecting the project developers of renewable energy projects like solar farms and corporates or the clients of banks or whatever who want to get those tax credits. And they're able to essentially buy those tax credits for 85, 90 cents on the dollar or something like that. And they're able to get a discount on their tax bill. So it's a win-win. And that's a marketplace software-enabled solution that has made the friction to access a lot of the benefits of the IRA possible, right? The thing I'll end there is that was the rationale behind investing in Eli. The company Eli, I would describe it as it's an API for the IRA, but really it's incentives that relate to electrification and energy transition. So you can imagine if you've ever tried to buy an EV or you've tried to upgrade the energy efficiency of your home by buying like a heat pump, accessing the rebates and the tax credits and the incentives in general at the city level, the state level, and the federal level, it's a cluster. This company, what they do is they're able to, in the transaction flow, they're able to help you determine, okay, if I'm buying this electrification product, let's call it a heat pump, which is super energy efficient air conditioner plus heater product. You should be able to know, all right, these are all of the incentives I'm eligible for. Some of those are means tested, so you have to do some income verification tests, right? Specifically, there's a climate equity component for the lower and middle income folks. You want to be able to process it like TurboTax. If anyone has done taxes in America, it's kind of an onerous process. This software product allows you to very easily process the rebate application or the multiple rebate applications that you're eligible for. And then last but not least, you're able to basically kind of like a firm or earn-in fintech products, able to factor those rebates or incentives to get the dollars in the door in hand on day zero at time of transaction. Here you have a product that makes it basically frictionless to access the subsidies that were entirely designed to get you to buy. But because it's so hard to access these subsidies, it's so hard to understand them. Even if you understand them and can get access to them, you have to wait 60 days, let's say, to actually get the dollars in your checking account, preventing a lot of lower middle income people to make the purchase in the first place. They basically streamline all of that. That's a software product that should exist. Tax credits have been around for decades. There are these companies that have been doing this in a consultative way for 40 years. Those companies aren't going to go away.
It almost sounds like these are effectively fintech companies, more or less, or at least have somewhat of a financial component to them that improve the business case of green solutions. Is that maybe sort of a neat way to tie it up in this case?
I mean, the first example I shared about optimization of batteries, I guess you're doing energy trading, so there isn't a financing element to that or a fintech element to that. You're right. I would say it's broader than just fintech. I mean, if you want another example, we bet on a company that has done really well in Europe called Breathe, which is a battery optimization product. And they basically have an AI software-only solution that reduces the EV charging cycle. They optimize the battery such that they're able to cut down a meaningful amount in terms of a rapid charge, right? Now, Volvo has rolled them out in every premium electric vehicle they have that they're manufacturing. That's not a fintech product, but there's a lot more of those optimization plays that I think are really exciting to me, at least.
That's awesome. And it's cool to see, I guess, like a lot of times we hear about how much energy AI is sucking up. So it's nice to hear that it also can sort of reduce energy consumption on the flip side.
If I can just share one or two more examples, I know I tend to ramble, so shut me up if you want, but
no,
I have gotten really excited about geospatial data. I think we're on the cusp of a big Cambrian explosion of Earth observation data, remote sensing data. I think the first generation of satellites, they were Planet Labs, great company. I think we're fans of those companies. There are waiting in the wings, waiting to launch in the next 12, 24 months, a number of satellite companies and aerial imagery companies and that are going to be able to collect data about the Earth's atmosphere, the oceans, and the surface of the planet in a way, in a level of detail that would blow people's minds. When there is a new data asset out there, what can you do with it? I think that's where my mind goes in terms of interesting new AI applications in climate. One of those examples. So I bet on a stealth satellite company that does that. And they have designs to go build a foundation model for geospatial in a way that allows you to do things like identify where critical mineral deposits are from space, do precision agriculture that identifies crop disease in real time, identify where the methane leaks are, not to mention a lot of the defense applications, which is a dual use thing. And there are a crop of weather AI companies. We're coming on the backs of Hurricane Helene and Milton, right? Massive amounts of damage. And how do you better predict the path of these storms that are going to be increasingly volatile and intense? And that has implications for aviation. Like, when do we fly our planes and when do we ground them? For SpaceX, like, when do we launch and what windows are closed to us because it'll be too dangerous? There's many, many applications that are based on geospatial and weather data that clearly not a fintech company, but those companies I think are potentially massive magnitude outcomes.
Yeah, no, that's super interesting you bring it up. I recently spoke with a company called Precip AI, which does sort of like really detailed models around precipitation to help sort of farmers better understand how much rain is actually falling in different parts of their fields and also to predict floods. So, and it also, to your point, has optimization opportunities for fields like agriculture, but they were really sort of like tapping it also as like flood basically analysis or resiliency to better understand like where floods
exactly right.
So given what happened in North Carolina is super relevant. So
exactly right. I mentioned at the beginning of the call, reinventing insurance is something that we think about a lot. I mean, there are homes out there that are uninsurable right now because of wildfire risk, because the traditional insurance folks can't price the risk. That's a technology problem. It's a data problem. And it's where AI can help. I mean, if people are curious about this, we also backed a flood insurance company called Floodbase. They have just released a new product for municipalities, for cities in California to deal with atmospheric rivers, which are creating a massive amount of damage every year now. And we have some interesting stuff up our sleeve that I can't talk about for the wildfire risk part of the equation, but there's just so much opportunity there.
Yeah, that's awesome. The next thing I kind of want to pivot into is understanding how you think about deals and making investments. Obviously, at the early stages, the founders and the team matter so much because the idea will most likely pivot once, twice, three times before it sort of like finally reaches its full conception. Maybe we take one of the examples of the companies that you talked about in the software or even the hardware moment. Like, walk us through sort of what you saw with that particular team, with the product, and that made you like really excited to go ahead and pull the trigger to make the investment.
Yeah. Wow. What a great question. I think the company that I will probably reference here is probably Crux, actually, which I just mentioned. Crux is, I describe the company, marketplace for IRA tax credits. There were 8 of these companies, I think. I met 7 of them, of the 8, at the time of our investment. And I think the thesis became obvious as soon as the regulatory inflection came about. This is a lesson I learned from the folks at Floodgate, where I was a seed investor. Mike Mabels and Americo there are probably the best academic minds of around 0 to 1 startups and evaluating whether your idea is big enough. And I think something that Mike has really drilled, and Mike and Ann have both drilled into me, is look for change events in markets. You got to look for either a technology change, like maybe that's AI, maybe that's a new way to do data engineering for some of the geospatial stuff. It could be a consumer behavior change. I mean, the pandemic is the most obvious one. We're all on Zooms now. That behavior change yields new interesting companies. And the one that's most relevant for Crux is the regulatory change. IRA has passed and there are new opportunities that can be built on top of that regulatory change, as long as you believe that that opportunity is enduring, which we do. And when that change came into effect, I think there were 2 or 3 teams that particularly stood out as folks who could see around the corner. They knew that if this bill passed, there would be opportunities that looked like Crux and already took the shape of speaking to customers and having a clear understanding of the pain point and the types of features they would want to build into the platform, which really just ended up being liquidity. A marketplace that has liquidity where if I post my project, I will know that I will get the most potential bids for each potential credit and I will get the best price for my credit. People who deeply understood the market, understood their business code, really understood their economics. And I think what I was very excited about with the Crux guys, Alfred's the CEO, repeat founder, had previously exited his past company, which was a lowercase portfolio company. So we had a little bit of an edge in that we really had seen him, we'd seen him in action before. I think his perspective on how to build the vision of what he wanted to build, I can't really speak about every element of the secret sauce here, but he had a really compelling argument for distribution to get in front of and very quickly get in front of all of the developers and the potential tax credit buyers through, I would describe, channel partnerships. And I think he had a very clear view of trying to build like operating system for renewable energy finance in general that went beyond just marketplace for tax credits. That was exciting. And the guy was just charismatic. You knew that you wanted to work with him. You knew that he's going to be able to raise capital. And that's proven to be true as well. I mean, he raised an enormous round led by Andreessen Horowitz and some of the marquee fintech investors of the ecosystem. I think that it came down to founder. It came down to insight into the market. It came down to ability to articulate a story that we had confidence would reduce financing risk and talent risk. And you're in a land grab situation, so you want to be around a person who is an execution machine. And in Alfred, we found that person. So I think that's one example, but happy to go through other examples if you're curious.
No, that's super great. And it's given that we had Mike come talk to one of my classes this week and he talked about inflections and insights, it's interesting to see how that still is a very relevant framework for you these days. The inflection was the IRA. The insight was around liquidity and people wanted to be able to post and get instant or quicker and better deals. You mentioned this particular founder, Alfred, was a repeat founder. And a lot of VCs tend to prefer repeat founders because they've made the quote unquote the mistakes the first time around or just more experienced operators and executors. Do you think that's really true? And do you place a lot of weight on sort of repeat founders, or are you just as happy to back a first time founder if you think they kind of have what it takes to get the job done?
Oh man, it is night and day, man. I think first time founders, everyone has to go through it once, right? But you don't know what you don't know. You don't know what certain things might be hard, and you have less of a clear conviction on where to spend your time and what things are not as big of a deal as they might seem when they first pop up. I think of 2 founders in our portfolio that embody like repeat founders are just know how to see around the corner better. And that's Peter Reinhardt, who founded a company called Segment back in the day. And that company sold for a couple $2 billion, pure software company. And he decided that he was going to build his next company in climate. He founded a company called Charm, carbon removal company. And he had him in belief that Charm will be the company that he's known for, not the several $1 billion acquisition that was Segment. It will be a larger outcome, economic outcome, and the company that actually he wants to be remembered by it, but in terms of just legacy and impact on the world. The way that he has approached just really getting to product market fit, to market shaping work, to raising capital. I mean, he's a known entity, and so a lot of people want to throw money at him, but ability to really move very quickly on delivering carbon removal, tons removed. I think it's just a world of difference compared to some of the first-time founders, especially first-time founders in carbon removal. The other founder I think about is Matt Rogers, who is a founder of Nest, and his next company, his current company, is Mill, which is a product that basically you're able to offer up the food waste in an odorless way, in a very quiet, silent way, is able to create food grounds out of the food waste. And those food grounds are actually useful for a bunch of applications beyond just regular compost, right? It's reinventing compost is one way to think about it. And again, I think his vision and the magnitude that he is shooting for is they're trying to build generational companies. They know what good looks like in terms of executive talent and really strong leadership around the table. They know what a good investor looks like, or can be picky and choosy about that. And again, the velocity piece of moving quickly on the things that matter in terms of achieving the product market fit and not sweating the small things when something goes wrong, when the hire leaves the company or whatever. Those things are just kind of very obvious. It's really fun to watch them at work.
Totally. Seeing that we're sort of like creeping up on time, I kind of want to, given that we're an MBA podcast, I always love to ask about sort of advice. VC is a notoriously like difficult industry to break into. And I guess a lot of us MBAs probably don't have necessarily super technical backgrounds, so not PhDs in biology or chemistry.
Neither do I.
Whatever it is. How do you recommend somebody, A, to break into VC, and B, break into sort of the climate change space if you're not A, a technical person, or B, just the nature of getting into VC is challenging?
Yeah. Well, I'll tell you a little bit of my story. Maybe that'll illustrative here. I think there's some lessons here. I mean, I was in the founding team of a YC company ages and ages ago. And one of our board members is this guy, Anjay Midha, who now is a GP at Andreessen. He runs their AI fund. And at the time, I learned that he was 24 years old at the time. I was just like, how are you 24? And he founded the seed stage practice at Kleiner and had done all these incredible things. And he very simply was like, hey, I was a partner at Dorm Room Fund, which is this student-run fund, originally backed by First Round, now backed by a bunch of people, including seed funds you'd know. And when I learned about that, I was really intrigued. He introduced me to Josh Koppelman, who lives in Philly and who founded First Round. And that's how I started getting to know some of the Dorm Room Fund folks. And I was very fortunate to be a partner at Dorm Room Fund, where I could learn the ropes, understand what good founders look like, and deploy real capital and kind of really just be in the network of smart and ambitious young founders in school. And we got stupid lucky and got involved in some companies that have done extremely well. But the lesson that I would impart to MBAs is that I spent a lot of time with undergrads, at Penn in particular, but also at Harvard, at Stanford, at all the typical suspects. And constraining your worldview to deal flow and founders and talent just in the MBA bubble, I think is doing yourself a disservice. I think if you expand the horizons to trying to meet like PhDs in labs who are interested in commercializing interesting technology, or undergraduates who are just wonderkins, and they exist out there for sure, at thinking just yesterday and today, I'm spending time with a Dorm Room Fund, ex-Dorm Room Fund alum who is building an incredible robotics company. And so like he's, 25. My point is meet the undergrads, because when I left Dorm Room Fund, we had backed 3 founders as an institution that were aged 17, 19, and 21. And today, you fast forward today, the 3 folks who have built 3 separate companies, that's $3.5 billion of enterprise value. Those were absurd companies that were built by undergrads. The initial iterations of the companies they built, some of them didn't make sense, but they evolved them, and they were obviously going to be founders who were going to make it. That's something I would stress. And all 3 of those came from Penn, by the way. And I think that's actually really, really important. Anyways, Dorm Room Fund was the thing that ultimately allowed me the launching pad to hunt for deals and ultimately get me in the door to meet other GPs at other firms. And my pitch to them was basically something like, do you want to know who the 10 best engineers are at the top 5 engineering schools in the country? I have a good guess at who those people are. And if you have a better guess than me, we should talk about it. And the hit rate was like 99%. Everyone wanted to know who the next best engineer was. Even if they weren't a founder, they wanted to just place them into the portfolio company. The lesson there is like, okay, what is your pitch to investors? Like, what is your superpower? What is unique about your story that allows you to find a GP who's willing to champion you? And finding that champion actually looks a lot more like finding a best friend than getting a job. It's more of a campaign than an application. And what I mean by that is no one goes up to people and be like, do you want to be my best friend? I mean, maybe some people do, but it's more like you get to know each other. There's chemistry, you have common interests, and you teach each other stuff, and you learn to depend on each other in different ways, right? Same thing for venture capital. What are they going to depend on you for? Are you going to be able to deliver them founders and deal flow? Are you going to be able to teach them a thesis and convince them that thesis is really important and they're stupid for ignoring it, right? That particular piece is how I think a lot of my friends who were really smart about crypto or climate, for instance, were able to convince generalists to spend time with them and say, okay, you don't have a crypto person? That's stupid. Or you don't have a climate person? That's irresponsible to your LPs. And the last but not least is this is a first round lesson. I think you got to think of yourself as a product, both to founders and to investors. What is the product that you deliver and how do you consistently deliver value as a product? So something I used to do was like I would host dinners and I would bring together the most interesting founders of a particular school. Stanford and Penn were the two, and Cal, and basically have a guest of honor and say, hey, I think these are people you're going to want to meet on campus. Do you want to be the guest of honor? If not, no worries. Who would you recommend to take your seat? 9 times out of 10, they would ever refer anyone else because they want to take that seat themselves. If you do this consistently, provide value and your unique flavor and pitch them on deals that they should be looking at and they actually do it, teach them something about a thesis area and convince them that it's important and consistently deliver a product that they're like, we do not want. I mean, this is a quote I got from Mike at Floodgate. He's like, we did not want you to go work at First Round. So he offered me a job, which that relationship started because I came up with a pitch competition for MBAs. So MBA founders, it was the Wharton Entrepreneurship Summit. And I did it at Google SF and hosted a Google SF with my good friend Jerry, who's now a partner at Mavron. And we hosted a bunch of MBA founders and I cold emailed Ann Miraco at Floodgate and said, can you judge this? She said no, but she said, you know what? My partner Iris is a Wharton alum and she'd love to do it. And Iris ultimately became my champion and introduced me to the rest of the partnership. And that became monthly coffee chats, became dinners, became, do you want to just work here? And I think maybe that helps illustrate a little bit of some lessons from my journey, at least that could be helpful. Does that answer your question? I rambled a bit there.
No, I think that's probably one of the most honest answers I've gotten to that question. I've done this podcast many times now, and I think that's and asked similar questions. So I think that was an absolutely phenomenal answer, and you sort of really painted out the path. Really appreciate it. We're at time, so we're going to wrap things up. But I absolutely love this episode. Thank you so much again for your time. Really appreciated it.
Sure. Good luck, guys. Wharton was a very special time in my life. Go have fun. Enjoy Voyeur. And if you ever need anything, just shoot me a note. I'm just Shawn at lowercarboncapital.com, SHAWN. Catch you soon. And if you want to jam about climate, let me know.
Awesome. Thank you.